Viewpoints on the Talk Station FM 107 AM 1240. Our guest has her very own chair, which we've dusted off in her absence. One of these days she will occupy it. She has occupied it in the past. That being Willo Kelly. She is the Government Affairs Director for the Outer Banks Association, Realtors and Home Builders, and has been not only our guru on insurance for issues related to insurance rates, but frankly, and I say this many times, and I thank the folks in Dare County and the Outer Banks area for, giving Willo the license, the ability to share her expertise with us in issues particularly that are confusing and complex and sometimes, downright crazy. And I thank them, but I also thank Willo for the amount of time she really spends on this issue of insurance. And Willo, I am effusive when I talk to you, but you bring so much logic and so much information to the table. And sometimes, unfortunately, it's like drinking large quantities of water in one gulp. You got to do it one at a time. So periodically, you and I end up revisiting some little issue, but they're issues that I'm confident many of our audience misses from time to time. So with that as an introduction, and thank you very much. Appreciate you taking the time to be with us today.
Thanks for having me again, Lockwood, as always.
Well, let's start with, and neither you nor I have really discussed how we want to set this conversation up. I want to start with just the North Carolina issue of insurance and the proposed rate increases. We have two basic insurance issues before us. And then at the bottom of the hour, when we come out of the bottom of the hour, we're going to talk about the National Flood Insurance Program. And that's something that, as I mentioned before you joined us, our congressional candidates need to not only know, but give us some indication of what they will be doing on the behalf of coastal North Carolina. But let's start with just the state policies in general. And we talked last week because I was concerned about the investigations that associated with Mr. Lindbergh and the Department of Insurance. But as we all now know, Mike Causey is, quite frankly, not in any threat and has been extremely, we'll use the word, appropriate in his actions. But let's talk about the issue from the topic of North Carolina filings. And North Carolina had a rate increase requested by the insurance companies, and it's now been developed to what? Is it 19% average across the state? Is that correct?
I believe we were somewhere around 17%, 17.4, somewhere around there, with regards to the overall statewide average rate increase. Yes. Right.
And that, by the way, that's statewide. So you've got the rates on the coast versus the rates on the mountains, and then you've got rates where the Piedmont areas and what have you. So when you average those all out, we're not talking median, we're just talking average. That's another issue here. But
correct.
This is a topic that's going to create a certain amount of discomfort, I would think, for many homeowners. We're already hearing people who have seen increases in their insurance policies upwards to $400 or $500.
That's correct. And we are likely not comparing apples to apples when we talk about just looking at rates across the state. The state is broken up into many territories, as it should be, based on location. Of course, along the coast, you're more at risk of damage from coastal storms, hurricanes, mountains. We've seen issues there with, we've had rock slides, we've had landslides, we've had all kinds of things. We've had flooding in the central and western part of the state, not only on the coast. And so due to your location, your geography, you may be at a higher risk for some type of peril. So therefore, the state is broken up into all of these different territories. And so the rates are based on the losses within those territories, the risk within those territories, whether it be a modeled risk, and that is based on, now they have to use two different models to determine, actual possible risk. So you're not just looking at loss history in some areas of the state. We use coastal models here on the coast that are incorporated into developing our rate. So there are many factors that go into how a rate is determined within these many, many territories across the state of North Carolina.
And in the midst of all of this, of course, is the concern that sometimes these rates seem almost arbitrary. Based on our previous experiences and conversations, that is, we've seen situations where you've seen models that predict all sorts of, catastrophic events, but we don't have the history to justify that, particularly in coastal North Carolina. Am I correct on that?
That's correct, because models are only good as the information that is put in them. Mm-hmm. So, there's the old saying, like garbage in, garbage out. Mm-hmm. It all depends on what data is entered into the model. So in delving into this about 10 years ago, it looked like the models that were created to determine risk along the coast included like storm data, wind speeds, et cetera, from like a Hurricane Hazel. Right. Hurricane Hazel in the 50s was the largest storm ever to hit, or category storm ever to hit the coast of North Carolina. And so that was our only Category 4 ever to make landfall in North Carolina. We've had the impact of Category 4 storms and whatnot that have come up from South Carolina or have been off the coast, and by the time they've hit North Carolina, they've been a lesser degree of a storm. So you have this coastal storm model that says, okay, Hurricane Hazel hit coastal North Carolina again based on the development patterns of today. What would the potential damage, monetary damage, be to the structures and to these communities? And so they come up with, well, here's how much you have as far as the exposure in those territories. And the exposure from the insurance companies includes not only the cost to rebuild the structure, the dwelling values that's listed on policies. There's also other lines of coverage on those policies, such as personal property, other structures, loss of use. Sometimes you could have on your policy an amount for other structure, and you don't have another structure. It's just all part of what they calculate in with their exposure. So you plug all that data in, what the total exposure is, what the models show, what the loss history's actually been. Then you factor in the need for profit. I mean, there needs to be reasonable profit in order to engage and remain in business. So through legislation and general statute, it says that these companies, through the rate, it has to provide reasonable profit. Right. So you have to factor that in. Then there's a bunch of other little things that are included in the rate. One of those things being the company's risk of assessment if, in fact, the beach plan, or perhaps and this is that wind pool, coastal wind pool is now called the Coastal Property Insurance Pool. If this entity that was created many years ago that allowed for coverage to be written on the coast first for dwelling policies, et cetera. I'm getting in the weeds here, right. Lockwood, and I'm trying to stay away from that.
But I appreciate that. No.
Yeah, but included in the rate is actually an amount in the event that the insurance companies, the carriers, the underwriters, ever have to pay an assessment back to the beach plan. If it goes belly up and for some reason you have a catastrophic storm that wipes out the coast and there's not money there to pay claims, then the carriers then have to put money into the beach plan to make that up, and then policyholders across the state could be assessed. That's likely not to happen, considering the health and viability of the beach plan, that it is in great financial shape, even with all the losses last year.
Yeah, let's talk about that.
But they're getting that rate on the front end. That was going to be my point, that they're getting that as part of the rate statewide in all these territories on the front end. And so that's all counted towards it. And so a few years ago when we had a hearing on a filing, it was like, well, we kind of found that you're using wind speeds that are excessive, and therefore if the wind speeds we feel are excessive, then your modeled losses are going to be excessive. And so therefore we feel that your potential risk is much lower than what you're saying it is, and therefore this is the outcome of the hearing that we're having. So many, many factors. Bottom line is we're all going to pay rates based on, hopefully, our loss history and hopefully as accurate as possible, perhaps projected risk. But we don't have, that crystal ball that's going to tell us.
Right.
It's like this year we have hurricane. They come out with the Hurricane Center comes out with what the forecast is, and anytime I see where the forecast is going to be really bad, we've actually had good years, and I think this year it's showing it's going to be really good. So I'm a little nervous that we're going to have more hurricane damage because it's never what they say it is.
Well, the other aspect of this, Willo Kelly with us, by the way, we're talking about insurance, and this is a topic right now where, as she just mentioned a moment ago, we are a little bit into the weeds. But the aspect of this, Willo, before we go to the break, let's talk about some of the instances of rate changes that you've seen just there in Dare County. I know for a fact, talking to one individual, $500 increase just this past, I think it was November. Just this past November, he saw a $500 increase in his insurance policy.
Sure.
You had an instance which was even more, right?
Oh, it's. I'm hearing some crazy things, and I'm getting on average about 3 to 5 calls a week, emails, somebody asking me, hey, I've just gotten my renewal. Here's what's happening is new rates did go into effect October 1 of 2018. This is new rates. October 1, 2018. This has nothing to do with the rate filing that just happened. So everybody's calling like, whoa, wait a minute. I didn't think the rate increases were 40%. I didn't think the rate increase was, I've heard as high as 60%. I've heard 100%. My insurance has doubled. What's happening here? And we're not talking about a $400 policy, a $500 policy, going to $800, $900, $1,000. We're talking about somebody with a $1,500 policy that all of a sudden homeowners, not flood, not excess wind, full homeowners or homeowners and wind combined, they're seeing tremendous increases. What went into effect in October for much of just about all of eastern North Carolina, we should not see any increase higher than about 6%.
Right.
That was what was approved effective October 1, 2018. Even across the state, I'm looking at what was approved in October 2018, and I did a little chart all the way back to 1993 where we've seen rate changes. And I think there's one area, Avery and Mitchell County, that actually they're seeing a decrease of almost 6%, a little over 6%. Another western part of the state, 4 counties, seeing a decrease of 10%. So the maximum increase that was approved was less than 6%. So these changes that people are seeing on their premiums, I say take a good look at a couple of areas on your policy. Okay. Take a good look at what that dwelling value is and ask your agent if you signed a consent to rate form.
Right. But automatically now, consent to rate is automatic, is it not? And by the way, consent to rate, define that for the audience, if you will, Willow. This is a topic that this is, again, another subject that homeowners and insurance purchasers need to ask. Define what is consent to rate, if you will.
Okay, consent to rate, CTR, as it's referred to. Consent to rate is something that is allowed for the insurance underwriters to use in the event that the intent of consent to rate was if you have multiple policies, if you have multiple properties and you have one that your insurance carrier is saying, you know what, we just can't write that coverage on that property. It's an historic property, it's their property, it's in a high crime neighborhood, it's it's just a more risky property. We cannot write coverage on that. We're sorry. We just can't do it. And so the loophole in legislation regarding the insurance rate making process says that, well, in those instances, you always have the FAIR plan or the beach plan to fall back on. That's your market of last resort.
Right.
But if the admitted market or the other carriers want to provide coverage, you then have to give them the authority to write that over and above what the Department of Insurance says is the maximum rate that should be used. So you are agreeing for them to charge you more than what the Department of Insurance says you should be charged.
And now, if I'm not, and it used to require a signature, right?
Okay. Well, here's where it gets a little tricky. When 2008, 2009, what happened there? We had, downturn in the economy. We had the investment markets went south. Insurance companies are investment companies. They are. It's not they're sitting there and you're paying your premium and they're taking your premium and they're putting it in a pot of money over here or they're putting it somewhere safe, and then when it's a rainy day they pull from that money. There's actually laws that keep them from being able to do that. They can't keep but so much in reserve. So they can't just stockpile a bunch of money in the good days and then in the bad days, they pay it out. That's the way we think insurance works, but that's not exactly how it works. So with regards to consent to rate, we're going to charge you a higher rate. We're going to put this form in front of you, and we're going to say, please sign this in order for us to provide you coverage. Little do you know when you sign that paper that as long as you're with that same carrier for 10 years, 15 years, whatever, at any time at renewal in the future, they had the ability to charge you up to 250%. Yes, that's 250%. Over what the rate approved by the Department of Insurance was. So legislation changed last year to say, okay, let's go back and look at consent to rate. Having the policyholder sign that form is becoming burdensome. It's kind of a moot point. People don't know what they're signing anyway. And in some cases where it wasn't signed in a timely manner and the premium wasn't paid, all of a sudden the policyholder finds out that they don't have any coverage. So, you know what? We're going to do away with the consent. We're going to do away with the policyholder having to sign a form. Legislation changed that said the insurance carrier can now go up over and above maximum rate allowed 250% up to 250% at any time on your policy without your written consent, but they will now have to provide in bold font on somewhere in your policy that says, here's basically what you should be charged and here's what we're charging you. And unfortunately, most people don't read their insurance policies. They only look at that one page that says,
the bill.
Hey,
this is
here's how much you owe and here's when it's due. And even more so, if you get that big packet of information, it's very intimidating, unfortunately. And you don't know what questions to ask your insurance agent. And when you see a big jump and you say, wait a minute, I mean, even for those that keep track of from year to year, how much did I pay last year? How many of us can say right now in a split second, how much did you pay in your homeowners insurance last year?
And on top of that, watching the annual increase as you go through, say, 5 and 10 years. This is an important issue. And we've got to take a quick break. I want to transfer from this topic to the issue of national flood insurance because we're talking about the potential increase. I'm
always the bearer of bad news.
I know.
News. I want to bring good news.
Okay. What by the way, what we're talking about, if I'm not mistaken, what's it called? Flood insurance, risk rating 2.0.
2.0.
Yeah.
2.0.
Risk rating 2.0. Ladies and gentlemen, stay tuned. This is the topic that needs to be discussed with your congressional candidates, wherever you are in North Carolina, but definitely here in the 3rd Congressional District. You're listening to Viewpoints. Our guest this afternoon, Willo Kelly. We're talking insurance. Viewpoints on the talk station, FM 107 AM 1240. We have joining us this afternoon, Willo Kelly, and we were chatting a few moments ago with her about North Carolina rates and the challenges we face. And I remind you that insurance is becoming now a major portion of our living expense. But associated with this is, what is it called again? Risk rating 2.0, Lockwood. Risk Rating 2.0. This having to do with the National Flood Insurance Program. And Willo, my house is 3 miles from the Atlantic Ocean, so I don't have to worry about this, right?
Come on, Lockwood. You're close to the water. We're now going to not only have where you are going to pay a flood insurance premium based on the 100-year floodplain, based on flood maps, et cetera, et cetera. You are now going to have another layer of risk, which is how far you are from the water when you pay flood insurance.
And by the way, ladies and gentlemen, National Flood Insurance Program, NFIP, is a federal program, and I'm going to reiterate what I said something earlier, Willo. Your congressional district, your congressman plays a key role in this. So if you're not asking those candidates about this, shame on you. Go for it, Willo.
Well, this all started a couple years ago, and I actually had to go back and look at emails back and forth between, our representatives, and Congressman Jones was on it, and, what are they thinking? Okay, so this is supposed to be National Flood Insurance Program, okay? Insurance is all about the spread of risk.
Right.
So the more people in the pool, the less everybody pays, right? Because you're not going to have everybody damaged at one time, et cetera, et cetera. So flood insurance program, National Flood Insurance Program, created in the 60s after Hurricane Betsy slammed into New Orleans, almost 40 years and 2 weeks to the day of Hurricane Katrina. So this isn't anything that started new because of Hurricane Katrina or Superstorm Sandy. This was well in place years ago. In the 70s, it was turned over to manage by the federal government, turned it over to these 90 or so called write-your-own companies to run the program. Okay, well, everything was working fine until Hurricane Katrina, and we had devastating loss and the political debacle that it was. That here we are, the great United States of America, and we're watching on TV while people are stranded and we can't get to them. So people started paying attention to the National Flood Insurance Program. It's bankrupt. Right. Money had to be borrowed from the U.S. Treasury to keep it afloat. $25 billion in debt. Headlines. Bad news. Flood insurance program is broken. We need to fix it. And for the past 15 years now, 14 years since Hurricane Katrina, that's what we've been trying to do. We've been trying to fix a very broken, messed up program. And they have been trying to fix the program by putting that burden of fixing the program and paying the debt back to the U.S. Treasury on all current and future policyholders. They made some adjustment this year to what these 90, I think we're down to less than that now, companies that oversee the program. When I say oversee, they oversee the renewal notices that go out. Getting the folks entered into the system is typically done by the local independent agent, and then or the other admitted carriers, et cetera, by entering people into the system. And so you have these companies that were making 33% off the top out of the program. So for years and years and years, these companies got a third before they did anything else. There's a fee schedule when it comes to paying claims, when it comes to the adjustment of losses, et cetera, and whatnot. So Katrina, losses. Oh, my God. Superstorm Sandy, so many years later, tremendous loss. And how often do we turn on the TV today and we see damage from flooding?
Midwest.
We see damage from flooding in areas that are quite a distance from the water.
Exactly.
We see damage from flooding in areas that, you'd never, South Dakota, West Virginia, you're talking about states inland, way far from the coast that are having flooding. So within the insurance program, there are two models used to determine insurance rates. There's a coastal model, and then there's an inland riverine model. Coastal model is based on storm surge. Riverine model, as the water rises in rivers and whatnot, who's at risk. In a 100-year floodplain, and that means that there's kind of a 1% chance a year that you may have flooding within these waterfront so-called communities. Well, there's many phases of flooding. There's failure to maintain infrastructure, storm drains, storm ditches, conveyance of water, building an entire community in Texas where you have no stormwater management plan. That kind of could cause some flooding when you have an inundation of rain. And so through all this debate and discussion and looking at where losses have occurred, the National Flood Insurance Program and FEMA have gone through a re-rating process, and they came up with a great idea that this national program should now be narrowed more so to charge people that live closer to the water a much higher rate.
Oh, lucky me. So I'm 3 miles from the ocean, but I'm close to the ocean, therefore I am going to pay a higher rate. Now, I've never had a flood. I'm on high ground, all sorts of things, right?
Well, this is where it's going to get tricky, because we were paying based on risk, which is your elevation, which is shown on a flood map.
Flood map.
Okay, that's right. Your flood map. What we have the flood insurance rating maps. So flood maps, and then you also had built into that. Okay, here's your base flood elevation. How high are you above that? How low are you below that? The lower you are, the more you're going to pay because you're at a higher risk. The higher you are, the less you should pay because you are at less of a risk to be impacted by that 1% storm. Now, throwing in just how far you are from the water, because I'm looking at this article here, and it says, well, owners of homes closer to the water and more expensive to rebuild should brace for a spike in their premiums. Owners of homes farther inland and less expensive to replace should expect to see their rates drop. Now, I see major issues with that, those couple sentences. If you are building closer to the water, like here in the coast of North Carolina, your building code requirements are much more stringent than they are inland.
Absolutely.
So your risk is probably less than the homes that are inland. And then on the other hand, we are looking at a national program, of which it's not national anymore, where we are narrowing where the risk is and going to make those folks pay more. But let's throw this little curveball into the mix and the conversation, and everybody should be asking this. If they are going to charge now based on your distance to water and based on your flood map rating and where you are within that, above or below base flood, how about the actual coverage? Because the maximum limit of coverage in the flood insurance program is $250,000.
Right.
They are looking at possibly changing that. This is not like your homeowner policy that you can have coverage to replace your entire structure.
Replacement cost doesn't have that. This is a cap. This is an absolute fixed amount, right?
True. So are we also going to, and what about the separation of which the rate in a V zone, rate in an A zone is going to be, different A zone, V zone, but here, AE 2 feet above base flood is going to be the same as AE 2 feet above base flood inland as it is on the coast. But inland, you're also looking at a different model to determine where your base flood elevation is. So this makes absolutely no sense to me. It is looking at putting more of the burden in paying back the debt in the program and to maintain the program on those that are closer to water when we've seen flooding happen and predominantly in close places that aren't close to water.
Let's take, as we mentioned a moment ago, North Dakota, Oklahoma, Kansas. Yeah.
Mm-hmm. Yeah, not coastal properties. These are not coastal properties.
Right.
So and then when you get into the difference between coverage between a primary resident home, you live in your house year-round, you're going to get full replacement cost up to that $250. If you have a second home, I have a home that is in another county that I moved from, that I decided when I could not sell it, I decided to rent it. So it's a year-round rental.
Right.
I can't get replacement costs. I'm going to pay the same as the guy next door that lives in his house year-round, but I don't have the same coverage. And please pardon my language, but flood insurance in general is crappy coverage. It's just crappy coverage.
Stay with us. We're going to wrap it up here in just a moment. How serious is this? We're going to give you the date. And I would like to suggest pay close attention to this. You're listening to Viewpoints. Our guest this afternoon, Willo Kelly. She's having a good time.
I'm just having a great time.
Yeah, a little sadistic time, if you will. Here on Viewpoints, Willo Kelly, again, with the Outer Banks Association, Realtors and Home Builders Association. We're talking insurance, the insurance that directly impacts you, the listener. Stay with us. Viewpoints on the Talk Station, FM 107, AM 1240. We're wrapping it up. We pushed a little too close to the top of the hour. Willo, when is the National Flood Insurance Program supposed to go into effect?
Risk rating 2.0 is supposed to go into effect October 2020, but we haven't seen the rates. We don't know what they are. We don't know what kind of impact they're really going to have. And the private market is writing flood insurance. Check the private market if you have a mortgage and need flood insurance, because I'm seeing great premium prices on the private market flood insurance.
Willo Kelly with the Government Affairs Director of the Outer Banks Association, Realtors and Home Builders Association with us this evening. Thank you very much, Willo. Stay with us for more.
Thanks, Lockwood.